I've developed another indicator that I call 3C. Now what this indicator does is what I told you before, that the smart money, the people who move the market, are very quiet about what they do. So this indicator actually tracks very subtle changes in a stock, and it shows us periods of accumulation, and a period of accumulation might be somewhere in here. They're buying, and then as the stock moves up, they're selling into demand. Okay, periods of distribution where the stock is no longer going up, but it's going sideways. At this point, the smart money is selling their stocks, they're getting rid of them, and they're going into short positions so they can try to make money on the eventual fall. So here's what this indicator looks like. This is called my 3C indicator. Okay, now we're looking at a price chart from 2006 to our present day, and this yellow indicator is my 3C indicator. I developed it. Again, I received awards for this and have been published for this indicator. And this is one of the very few indicators that forecasts. Most indicators are lagging indicators, okay, because they have to wait for price and volume to occur before they give you a reading. This indicator is not a lagging indicator, and on a daily basis it works exceptionally well. What we're looking at is price of the S&P 500. You can see, okay, you can see it climbing. And if we take a close look at our indicator, you can see that our indicator is not climbing with price. This is what we would call a divergence. So this is what I mean by a leading indicator. What we are seeing is in the later half of 2006 through 2007, we saw this indicator. If we saw continued accumulation, this would rise with price. Okay, we did not see continued accumulation as this indicator went down, which meant smart money was selling over here. They started selling, and as you can see quite clearly, we went into a lateral stage, a top. From there we went down. Now we have a positive divergence that started, okay, over here, and especially between this bottom and this bottom. You can see the indicators moving up while price was moving down. And then we had a nice rally. So the bottom line is that as price made new lows over here, the indicator did not make new lows over here, which showed accumulation in this bottom, which led to our rally. So the shares that were accumulated at a very cheap price were sold into this rally for a profit. If we look at a different time frame, let's say 15 minutes, each bar is going to represent 15 minutes. We see a couple interesting things. Over here, as price is going up, we can see the beginning of distribution. Price goes sideways over here. There's distribution. We have an eventual fall. Okay, we get a renewed trend that's moving up over here, and everything looks really good until we get to these highs over here. And our indicator, instead of following price, is making lower highs instead of higher highs, and we got a sell-off over here. Now if we look at price has a low here, has a lower low here, has a lower low here. What's happening in our indicator? We're getting a positive divergence, meaning in this area we're seeing accumulation and a rally. So they're selling into that rally, and the evidence of that is that this indicator is not making higher highs. So what we can expect to see in the next few days is the market to sell off. And we can look at various different time frames to make strategic decisions or tactical decisions. One time frame maybe that we'll look at is a 5-minute. And on this 5-minute time frame, again, this is a very, very powerful indicator. We can see price, which is in green, making new lows over here. Our indicator is making new highs, or higher lows actually. This is a positive divergence, indicates that there's accumulation occurring by smart money, and what we see is a rally. So they bought in here, they're selling into the rally. There was good strength. Now the strength has dissipated, and what we're seeing is all these shares that were bought initially in here are being cleared out, and they're going from a net long position, from a buy position, to a net short position. And as price makes its highest high, you can see our indicator in yellow is making an even lower high. So this tells us that in probably the next several hours that we'll see the market sell off to some degree. We can look at all kinds of different time frames. I have different versions of this indicator that I use, and over here again we're seeing the same thing. We're seeing price making higher highs in green, the indicator failing to do so. This is on a 5-minute chart. If we go ahead and look at something like a 15-minute chart, again, like I showed you just a few minutes ago, price moving down, we make an equal set of lows, but at that point the indicator is moving up. This is showing us again institutional smart money accumulating during this phase. They're selling, everything is good until this point, and we start to make higher highs, and our indicator will not follow price to make a higher high than this point over here. So that tells us we're seeing again distribution, and we can expect to see a sell-off. I'm going to show you one other version of this indicator, and we're going to look at, let's say, a 15-minute chart. And this becomes an art form to look at this. It becomes just you looking at it right now is probably very difficult to understand, but see if you can follow along. Have a nice trend over here moving up. We can see smart money is selling into that trend. We get a reversal. At this reversal, we see smart money accumulating again. And remember, this is a 15-minute time frame, so what we're talking about is trading in terms of days. Okay, so we got the accumulation, price went up further. Okay, we made a high over here. We see another sell-off and a set of higher lows, which is again accumulation by smart money, and another run higher. And in this run higher, we don't see our indicator moving up higher, so that tells us again that we're looking at a potential reversal of price to the downside. So these are a couple of the techniques that we can employ